All right, Ignatius, here we go. All right, we're just gonna give it a couple minutes as we let people log in through Instagram and Facebook, and then we got some members logging in here on Zoom. So what I usually do is take the first few minutes of this time to let everyone know what we got going on with Azreia and what events we have coming up. Then we will be discussing here in a few short minutes short-term rental loopholes. Is it loopholes or is it exemptions? What do you prefer?
It's really an exception, but a lot of people call it a loophole. So
Got to use the hot words, right? The hot buttons.
yeah.
Short-term rental loopholes coming up. So for all you that do short-term rentals, midterm rentals, whatever it may be, you're changing the use of your investment property on Airbnb, VRBO, whatever it may be. We're going to discuss the loopholes for your tax benefits today. So right now, this is Azreia. This is not another lunch and learn. We do this every Wednesday at 12 o'clock. We bring in a real estate investor, a real estate service provider to help us better succeed in our real estate business. So here at Azreia, the Arizona Real Estate Investors Association, we've been around the Valley for 20 years, representing real estate investors throughout the state, from Tucson up to Flagstaff, right? So whether it's support, services, networking, training classes, education, government affairs, we have your back. We've been doing it, like I said, 20 years, and we got another 20 in us that we're going for. So that's Azreia. If you're on social media, you can find us anywhere: TikTok, Facebook, Instagram. Go to our website, azreia.org, YouTube. We're everywhere. So I'm going to jump into our events. Our monthly meeting, what we do on the second Monday of every month at Venue 8600. That's our main event. It's the only event in Scottsdale. Everything else is here in Central Phoenix. But what we do there is our market update. Every other month, Tina Tambor comes in to give our market update. We do the association update. We always have a trade show with all our business associates and service providers. And as always, we have an education piece. And this month is Fix and Flip February. Tracy Royce will be discussing and teaching fix and flipping. So make sure to be there Monday, February 13th. Then we run down to Tucson to our Tucson chapter, do the same show. Tracy will be coming down with us to Tucson. And on the fourth Tuesday of every month, the Phoenix Real Estate Club here at our Central Phoenix office, we go more into discussion, more networking, getting to know each other. And, mainly the discussion about the market is what's very important, because other investors from all walks of life come into the room, whether they're flippers, landlords, notes, short-term rentals. They just give their experience as to what they're seeing in the market. It's very important to hear what they have to say so you can make the proper adjustments in your business. So, and I didn't see you this month, Ignatius.
Yeah, I was busy doing 1099s and W-2s with year-end stuff. So yeah, we had a lot of stuff going on for January. Sorry, but I'll try. We usually try to make it once a month to one of those. So
just putting you on the spot. So subgroup meetings, we do these. We have about 15 a month. So we hit 200 events last year. So we're still at it. So if you look at the subgroups, once again, those are here in Phoenix. There's a group for every strategy pretty much, whether you're a fix and flipper. We have the fix and flip group. We have the landlord group, which is coming up on Thursday. We have a women's group. We play Cash Flow 101. You name it. We got groups in Tucson. We got groups in Bisbee. We got groups in Prescott. So if you need or want to network with other real estate investors, like-minded people, we have a group for it. Go to azreia.org/calendar and pick your meeting. Our forums, you don't not only need to network in person, you can now network on our forums online, top right-hand corner of the website. We have multiple topics that you can discuss that with other Arizona investors. You don't have to worry about being in a different someone in a different market giving you wrong advice. So you're dealing with Arizona investors here on our forums. We also, if you are a member, you do get the access to property posting section. So if you're looking to buy off-market properties or sell off-market properties, you can do that on our website now. Oh, let's see. Fix and flip training with Tracy Royce. So very excited about this. We created Fix and Flip February. So one of our biggest sponsors, which I'll talk about in a minute, is Home Depot and the Home Depot Pro accounts. So our executive, Brian, out in Atlanta, called a few months ago and said, hey, we want to support the Fix and Flippers. What can we do to have a great event, or anything we can do for your community? So we said, let's do Fix and Flip February. And he goes, well, who can teach Fix and Flip February? And I was like, well, first person, Tracy Royce. She's the best that there is. She's local in the Phoenix market. She's hands-on. She's doing multiple transactions. So she's a great person and a wealth of knowledge to learn from. So at our education piece, Monday and Tuesday, she will be teaching at our main meetings. But then what we're going to do is put together a bus tour Saturday, February 18th from 8 to 5. So the first half of the day, we're going to go out to about four or five different houses, all different levels of renovation. So you get a wide variety of experience. Tracy's going to walk you through those houses as if she's like a contractor. She's going to tell you what she thinks the bids would be worth, what the houses are worth, what she would do to the design, everything about the property. You're going to be able to walk through that house with her. And we're limiting it to 2 buses. We already got 1 bus filled. So that's about 35 people. So we got room for 1 more bus we're going to shoot for. Home Depot is going to be at all the meetings all week, as well as the bus tour. They're flying in from Atlanta. They got a bunch of swag they're going to give away. We're giving away gift cards at the meeting. So it's going to be a fun experience. Then the last half of the day, we're going to provide lunch on the 18th. So we'll get back, do a lunch and learn, and then we'll also finish off the day. And Tracy's going to break down, and have a discussion on what did you see at the properties. Here's what the values really are. Here's the budgets that we would really do. So you're going to get that full hands-on experience in the classroom and in the field. So registration's $99 for members, $129 for non-members. All right. Real estate without the bank, infinite banking concept, unbridled wealth. One of our business associates, they're flying in from Denver to do this class. It's actually 2 classes in Tucson. They're going to do it Friday night, February 3rd, which is on the website, all the details. Then they're going to come up the next morning to the office and do it here in Phoenix, Saturday, February 4th. So if you're looking to leverage the life insurance policy to lend your money out to your real estate investing projects, this is a great way to build wealth. So check out the website, get more information on Unbridled Wealth's event. Azreia show, Marcus Maloney have been doing this we're on episode 62. We just interviewed Jay Scott, who is a large contributor to the Bigger Pockets platform. I think he's written 5 books for them. Just check him out. He's a large multifamily investor, 150 units or more. We really break down in that episode what your team needs to look like. How do you raise the money? How do you find these deals? He'll even pay you 10%, up to 10%. Don't quote me on that. Listen to the episode. If you found them that 150 unit building, so you're talking about $100,000 paycheck. So he's a great guy to know. Check out Jay Scott episode, all podcast platforms and YouTube. Like I said, Home Depot, if you're a member, you get 2% cash back at the twice a year. You get 20% off all your liquids. So make sure your Azreia account is set up properly with your Home Depot Pro account and start getting those discounts and your cash back throughout the year. House hacking, we just published our first book with Patrick Allen. So this is now on Amazon, digital and print versions. So if you're looking to get started in real estate, easy entry, low down payment, leveraging the FHA, 3.5% down, buy a 4-plex, live in 1, rent out the other 3, live for free. Patrick's going to break that down as to why you should do that. All right, so love to have you as a member. We have 2 options, $125 a year. And it's more of like an a la carte setup, where if you're going to be here less than 10 times a year, I would recommend the 125 version. If you're going to be highly active and coming all year long, more than 10 times, $249 a year, very affordable. Like I said, we had over 200 events. We've gave back $1 million to our Home Depot members last year. That's just one program. We have about 40 other business associates that provide discounts and benefits to your real estate business. So head to our website, check that out. We'd love to have you part of the family. And that's all I got. So the man of the hour, Ignatius Jackson, our business associate, our new business associate. Is that right? Do I have that right finally?
That is correct. That is correct. So
love it, man.
yeah,
I bet I'm so
all officially signed up.
Signed up, business associate, so you can see him at the meetings. All his information will be on our website in regards to CPA service, and I'll let him tell us, what you do. But like I said, today's topic is short-term rental tax benefits. So I'll let you. I shared my screen. You could take it from here. If anyone has a question on Facebook or Instagram, just pop it in. We'll get it answered. If you're in the chat and here on Zoom, just pop it in. Otherwise, welcome.
Thanks, Mike. So yeah, thanks for having me. Happy to be a part of the Azreia family here. And so today's topic is on short-term rentals, but just to tell you a little bit about myself. Obviously, I'm a certified public accountant. I'm actually born and raised in Arizona, one of the rare natives in the professional sense that you'll kind of find here. So it's not too common that you have a professional like myself that's been here his whole life. So I went to Arizona State University and have my own CPA firm where we do accounting, payroll, taxes, tax planning, all that great stuff for the small business owners, real estate investors, and you name it, right? So definitely have quite a number of clients that do a lot of real estate stuff. So very in-depth knowledgeable about all the different real estate tips, tools, strategies, etc. And so you'll be able to find all that information out on my website, have a YouTube channel, and creating a new podcast coming up here in the near future as well. So yeah, should be pretty cool. So today's topic, though, we're going to talk about short-term rentals. Let me just share my screen. And I think that's that one. Is that showing up good, Mike?
Sir, it's perfect.
All right, perfect. All right, so yeah, we're doing short-term rentals. So we're going to do this a little bit of a disclaimer here. Okay, I always have to have this every presentation. This is for informational purposes only, basically. If you need some actual tax advice pertinent to you, you basically have to engage us. Is essentially all this is saying. And a lot of stuff on here is going to be generalities, not to your specific situation. So just something to think about. Okay. So what is a rental activity? All right. So when you talk about short-term rentals, right, that term rental, what does that mean in the tax code? Well, by definition in the tax code, a rental activity is a passive activity, even if the taxpayer is materially participating in the activity, unless the taxpayer is materially participating as a real estate professional. So I'm sure most of the people have probably heard of what a real estate professional is and the qualifications on that. We may end up doing a topic on that in the future, depending on what Mike wants to do about that. But it's definitely a great tool for people who are primarily in the business of doing real estate. But if you're not a real estate professional, there's this little short-term rental exception that we're going to talk about that you can get to. Okay. And so a rental activity basically is anything that's real or personal. So a lot of people don't actually realize that personal property, which would be things like vehicles, equipment, like construction equipment, stuff like that. Even if you're renting that out, technically it's considered a rental activity underneath the tax code. Okay. And so you have to kind of work through different traps to see if you can actually consider that to be a non-passive activity. So there's certain things that make it non-passive for personal property sometimes, but today we're talking about some real estate, so we'll kind of focus on that. Okay. Now, what is not a passive activity? Okay, so the rental of a dwelling unit that a taxpayer also used for personal purposes for more than the greater of 14 days or 10% of the number of days during the year that the home was rented at fair rental rate. So what does all that mean? Basically, let's say you have a vacation home somewhere, right? And you only used it for 14 days or 10% of the number of days that you rented it, then that could actually still be considered a full rental. Okay. Similarly, if you did use it for more than 14 days for personal use, then it's not considered a rental. It's actually, well, it's not considered a full rental, excuse me. You can still write off portions of it, but it's really more of a personal residence if you use it too much for personal purposes. And so now you get into some different rules and stuff like that. Okay. So in that case, that would not be a passive activity. Rental real estate activities in which the taxpayer materially participates as a real estate professional are also not a passive activity. And when the average period of customer use of the rental property is 7 days or less, that's where we start to get into the short-term rental exception. Okay. So a passive activity is something that is really important to know in the tax code, because what that ultimately means is you cannot write off passive losses against non-passive income. So non-passive income is going to be stuff like a W-2 job, business income from a business that you're materially participating in, interest on bank accounts, stocks, dividends, gains, all that kind of stuff. Those are all going to be considered non-passive activities underneath the tax code. Okay. And so from that standpoint, you're trying to take this ordinary income essentially and offset it with some of these passive activity losses. Okay. And so from that perspective, we want to, as much as possible, not be a passive activity. So how do we do that with the short-term rental exception? Okay. So that's going to be defined in this IRS regulation 1.469-1T. Okay, so if you are a geek like me and you want to go read some of this stuff, that's where you can actually find the reference as to what allows you to do this underneath the IRS regulations. Okay, so there's 3 ways you can be considered a short-term rental. Okay, the most common is the first one. The average period of customer use for such property is 7 days or less. Okay. Now, what that means is basically you add up all your stays for a year, and this is a test you do each year, by the way. Okay, so you add up your stays for each year for each customer, and you count up the number of days that that customer spent with you, okay, for that year, and you basically divide the 2 numbers. And if that average is 7 days or less, then voila, you got yourself a short-term rental. If it's more than that, then it's basically like any other rental property. Okay. Now, there's a second test that you can do. The average period of customer use for such property is 30 days or less, and the significant personal services are provided by or on behalf of the owner of the property in connection with making that property available for use by customers. It's a very important terminology there. So significant personal services. Think of things like hotels for something like this to qualify for this, right? So this is more of the hotel philosophy where you could have someone staying more than 7 days, but you're also providing a lot of services along with it. So you have a restaurant, you got dry cleaning, you got housekeeping that you can do daily, or even just a few times a week. So you got people that kind of sitting at a front desk, you know, at every beck and call. You got something that's wrong with the room, etc. I mean, so you got personal services that are being provided. Something in addition to, you know, just renting the space and utilizing it for whatever purpose. Okay. So in that case, you can, as long as the average stays are 30 days or less, then you got yourself a nice hotel type situation. Is considered a short-term rental. So it doesn't have to follow those passive activity rules. Okay. Extraordinary personal services. All right. Those are provided by or on behalf of the owner of the property in connection with making such property available for use by customers. What that essentially means is if you are doing so much extra stuff, right, that basically they're more so paying you for services than they are for renting the property in a sense, then it's clearly not a rental property. Okay. And based on that, it's more like a short-term rental, and it's going to be considered non-passive in that situation. Okay. All right. Now, once you meet one of those tests, okay, then you have to also materially participate in that activity, meaning each property that you want to consider a short-term rental, you would need to be materially participating in it, or you can make a aggregation election, or sometimes referred to also as a grouping election, okay, where you can essentially group all your short-term rentals together in one economic unit, essentially, and you add up all your time and effort spent on all those properties in order to qualify for material participation, okay? But you do have to meet this material participation test which is pretty much the exact same test for qualifying as a real estate professional. But we're going to go through and define that a little bit for you.
I have a question.
Yeah.
So in regards to the first test, can it, if you have 10 short-term rentals, so do you have to average out all 10 to be under 7 days, or is it one, or can they be separate?
Great question. So each property would need to meet that first test individually. Okay. The grouping would only be in reference to the material participation component.
Okay. Makes sense.
Okay. So yeah, so first test, you got to meet that individually for each property. Then to get to that next step, we can combine everything together if we need to. Okay, so short-term rentals can be subject to self-employment taxes. Important to note that they're not always going to be exempt from self-employment taxes. Now, what determines that is how much impersonal services are you providing. If you're providing a decent amount of personal services along with the rental activity, then you very well could be paying some self-employment taxes on that income. If you're basically just giving people a space to rent and you turn it over every time they leave, then that's usually not going to be subject to self-employment taxes. Okay. So depending on which one it will fall under is where you're going to report it on your tax return. So if you're not providing significant personal services, it's going to go onto Schedule E. Or if you're a partnership, onto just a the regular section of your partnership return that's considered a rental activity. Okay. I believe I don't want to try to quote off the top of my head. I can't remember, but I think it's like 8825 is the form number on the partnership return. Okay. So report on the Schedule C if significant personal services are being provided. All right. Now, typically this short-term rental exception, at one point I just want to make before we go into the definition of material participation, typically it's only going to matter when you have losses. Okay. Now, when you typically going to have losses in a short-term rental, usually it's just going to be the first year, at most maybe the first 2 years, when you're basically acquiring all the furniture, you purchase the property, you place it into service, you're doing bonus depreciation, all that kind of stuff, right? So that's usually where you're going to have those losses. After that first year, maybe 2 years, most short-term rentals are very profitable. And if they're not, if your rental's not very profitable after the first year, then it may not be a good idea to what you're doing, because it's a lot of work to not make any profit off of it, essentially. So just kind of keep that in mind. Like, we're talking usually about the first year or two when we're doing this short-term rental exception. All right, let's talk through the material participation definition. So there's technically 7 factors. I'm not going to go over all 7 because most people don't use 4 through 7. We only use the bolded ones that I have here, the first 3, but I did include all 7 on here just so that you kind of see the ways that you can qualify for material participation. Okay. So the first one, the taxpayer participated in the activity for more than 500 hours. And again, when I say activity, we're talking about one rental property. So one location, one building, whatever that activity is structured as. So if you have an apartment complex, for example, that has 10 units, then that's considered one activity. All right. If you have a single family house, that would be one activity. Okay. So it's one essentially rental property activity you would have to meet these definitions for, unless you're doing the grouping election. Okay. So the first one is taxpayer participated in activity for more than 500 hours. Okay. The taxpayer participation, was substantially all the participation in the activity of all individuals for the tax year. The taxpayer participated in the activity for more than 100 hours during the tax year, and the taxpayer participated at least as much as any other individual for that tax year. So let's dig into these a little bit. Okay. So let's start with number 3. So this one is probably the most common. The reason being is it's a little easier to do 100 hours on a single property than it is to do 500 hours on that property. Okay. So this is probably one of the most common ones, but the key point is here, you'd have to basically kind of know what time everyone else is spending on your property. So you either have to track that yourself, or you have your vendors track their time that they're spending for you and put it on their invoices. So like for me, for example, when I have rentals, I always have my cleaning crews or whoever I have doing stuff for me to tell me how many hours did you spend working on this particular property, just in case I need it at some point in the future. It's not that much effort for them to add that to their invoice or their bill that they give you. And so usually they're perfectly fine doing that. And that kind of helps you to be able to track how many hours they're spending on it. Okay. But if you can spend 100 hours on the activity and no one else, and that's any individual, by the way, it's not a company, it's an individual. So meaning if you go with a company that has 100 different employees and they send, they rotate like 5 different people, like 5 different cleaners or whatever, then that helps you to make sure that no one individual is doing more work than you are as the owner of the property. Okay.
Question.
So yeah, go ahead.
Yeah. Question. So you're saying vendors count as hours for us?
Correct. In terms of the material participation test, correct.
Got it. Okay. And the next question is, how do you recommend tracking the information? Is there an app or how are you tracking on all these hours?
So although I don't recommend any one particular app, I can tell you the one that I use to help me track my hours is called Reps Tracker. There are some other ones out there though that I think are available and pretty good. But really any good app that's going to kind of help you break down your time so you can kind of track that. Now, in terms of tracking your vendor hours, I currently am just doing that in an Excel spreadsheet. All right. Anytime I have an invoice that comes through, I just add that in there and I'm breaking it up that way. I am not aware of any decent app yet that helps you to track the vendor hours, to be honest. Someone on here may know of one that they can recommend, but because I've been trying to search for one that kind of handles both sides of that equation, because it is very important to know. Okay. So yeah, whatever means you can kind of come up with, as long as you can kind of document it and substantiate it in case you ever get audited, that's the most important thing. Okay. So taxpayer participation was substantially all the participation in the activity of all individuals for the tax year. Okay. So this one, it might seem easy. You might think in your mind, oh, I'm doing substantially all, but really this test is more like 90 to 95% of all the time spent working on that property is by you as the owner of the property. Okay. That's pretty hard to do for a short-term rental. Unless you're the one doing all the cleaning, you're doing all the maintenance, you're doing all the property management type stuff, like booking people, communicating with them. They need extra stuff, you're going to do that yourself. So you'd have to literally be doing pretty much everything in order to meet this test. So generally speaking, to be the safest possible, unless you're doing all those activities, we're usually not going to try to claim that one because it's a very high bar to pass. Okay. The third one for the 500 hours. Now, this is one that is very, very helpful when you do the grouping. Okay. So let's say you have 5 short-term rentals, right? And you do on average 100 hours for each short-term rental. That gets you above the 500 hours. Okay. Then you can group all of them together. And now all of a sudden you're material participating in all of them. Okay. So that's the one that's probably the most commonly used for the grouping because it's pretty easy to get to that 500 hours. And once you get there and you group everything together, then it doesn't matter how many hours everyone else is spending. Okay. So initially when you're starting out, you might be going for number 3, spending 100 hours and no one else is doing more than me. All right. But eventually you could probably get away with doing number 1, where you're spending at least 500 hours every year on all your short-term rental activities. And we're not talking about long-term rentals here or mid-term rentals. We're just talking about short-term rentals. So you have to separate the two per the regulations. You cannot combine those hours together to determine material participation. But if you can get there for just short-term rentals, then voila, you don't have to worry about this material participation anymore for all your short-term rentals. Okay.
Perfect.
Does that make sense? All right. So again, I'm not going to go through number 4. Here's 5, 6, and 7 as well. Again, this is a lot of verbiage on here, but I've maybe seen like 1 or 2 situations where someone utilized anything on this number 4 through 7, to be honest. Generally speaking, they're going to be on one of those first 3 tests when trying to confirm material participation. Okay. Cost segregation studies. Now, the whole reason for doing the short-term rental exception, like I said before, is to take losses and offset against your other income. Okay. So the main reason for doing this work for a lot of people, besides the profit motive, obviously there's a profit motive, right? Otherwise, why would we do it, right? There's got to be some profit motive. But I say the second biggest reason, let me say it that way. The first reason is the profit motive, but second biggest reason is the tax savings. And some people might reverse that, right? Some people prefer the tax savings over the profit motive, but nevertheless, one of the biggest factors of doing this is that you want to be able to take losses against your ordinary income, which ultimately decreases how much you have to pay the government. All right. I know we all love the government, but it's all great. So what we're trying to do is we're going to take those losses and offset your ordinary income. So you got a W-2 job, you got a business that has profit, any ordinary income that you have, we want to be able to take these and offset it. So if you do a cost segregation study, which I know we're probably all on this call familiar with these, if you're part of this group, I know we talk about these a lot, right? But if you do a cost segregation study, what that allows you to do is aggregate the purchase price, all right, plus any improvements that you're making, et cetera, and of that piece of real estate, and break it down into shorter lived asset classes, okay, between 5 and 15 years typically, okay? And if you can take a portion of that purchase price and break that down, you can get for 2022 assets or before that, you could potentially get 100% bonus depreciation, okay? For anything in 2023 that you purchased this year is going to be 80%, 2024 will be 60%. So it's going down by 20% each year until it gets down to 0, basically, okay? So bonus depreciation is sunsetting. Now, that said, I firmly believe that even though we got what we have in Washington right now, I firmly believe that at some point, these guys are going to extend the bonus depreciation. Will it ever get back to 100% for the foreseeable future? I'm not sure. I doubt it will get back to 100%, but I think we might go back to something like 50%, which is what we had for quite a while before the Tax Cuts and Jobs Act, where they changed it to 100%, okay? But for now, just expect that each year going forward, we're going to be going down about 20% of eligible bonus depreciation amounts.
If I can just jump in, I think you mentioned the other day, just to be clear for everyone, this is not for arbitrage.
Correct. Yeah. So you cannot cost segregate or depreciate something that you're doing rental arbitrage for, obviously, because you don't own the property. Okay. You can depreciate the furniture that you're purchasing and the stuff that you're furnishing it with, right? That's still eligible for 100% bonus depreciation, but not the property itself if you don't own the property. And that's not to say that rental arbitrage still doesn't work. We could definitely talk through that. I have one property where I'm doing that. So it's not to say that it doesn't work. It can work. And I have some clients that have been very successful at it. But, the biggest bang for your buck is definitely when you own the property and then you're taking this cost segregation study and allocating it. The other important distinction I just want to be clear about as well, if you're doing short-term rentals, unfortunately, it does not qualify for the 27.5 life on whatever you don't cost segregate, okay? It's only eligible for 39-year life on the remainder of the building costs. That's not put into your cost segregation analysis. Okay, so unfortunately, that's one downside to the short-term rental exception, or using short-term rentals instead of doing long-term rentals, is you don't get that favorable 27.5-year life on depreciating the remainder of the building costs.
And hey, another question. So, Michaela, good question. I was thinking about this. So, what if you have a multifamily and you're using units as a short-term rental? So you're kind of in that double play, like landlord, maybe a real estate professional, and you got the short-term rental aspect of it.
Yep. So there is a test. There's actually a test for that. Right. It's I can't remember the exact percentage off the top of my head. I want to say it's somewhere around 80%. So if 80% of the property, right? So let's say it's a 20-unit apartment complex and you're using, let's just say 3 units for short-term rentals and the rest of it's long-term rentals. Okay. That would exceed the 80% test. So in that situation, that property technically is considered a long-term rental property. Okay. And vice versa. If 80% of that property would be short-term rentals and the rest of it's going to be long-term, then technically you can kind of consider that whole property as such. Now there are some allocation rules where you could potentially subdivide that property into different assets, right? Assuming it makes sense to do so. But that gets a little sticky, so I won't get into that in too much detail. So, but like, for example, if you had like a house with a casita in the backyard, you can technically divide that, right? But when you're dealing with multifamily units, it gets a little more difficult to do something like that. So generally, you're going to try to classify all of it as one or the other.
So if you had the casita, you just long-term rental up front, casita as a STR. Is that what you're saying?
You could, in theory, do separate the two out and allocate your purchase price between the two and kind of consider them to be 2 separate units. Yep.
Cool. Love it.
Okay. So I actually haven't been looking at the chat. Let me see. Is there anything else in here?
No, I have been covering it, man. And yeah,
you've been covering it. Okay.
If you're on Instagram or Facebook, just drop your questions in the comments. We'll get it answered.
So yeah, so that's basically the topic of the day. I mean, the rental arbitrage definitely could be beneficial. So at the end of the day, if you do the metrics on it and you do an analysis and you figure based on how much you can get for the daily rental rate, right, and subtract from that all your costs, and if that's more profitable than doing it on a long-term basis, and then also factor in how much time you're spending to get to that point, right, then rental arbitrage could still make sense. But do you really care so much about the short-term rental exception? Probably not as much, but it is still possible, at least in that first year when you're buying all that, the furnishings and all that kind of stuff. Because some people spend 10 to 20,000 to furnish a unit sometimes. So if you're doing that much, you might want to be able to take that as a loss against your other income, right? And so if you don't meet the short-term rental exception, you're still not going to be able to do that either. So it still could be beneficial to try to get that exception as a rental arbitrage. It's just not going to be as fruitful as if you own the property. Okay. And one other thing I'll note real quick, because you mentioned midterm rentals earlier. So there is no such thing in the tax code as a midterm rental, right? You're either going to be considered a long-term rental or a short-term rental. Well, and really long-term rentals are just rentals in general, right? So by default, any real estate that's being rented is going to be a rental property. Now, you can get to the point where you can justify being considered a short-term rental property, right? But you could always just treat that thing as a regular rental property if you wanted to, and not fool around with the whole short-term rental exception. So that's always a possibility. But when you talk about midterm rentals, those are very fruitful. We attended or we had someone present on that the other day. They can be very fruitful, especially extended rentals, midterm rentals. But from a tax code standpoint, they're going to be treated just like any other long-term rental you might have. You know, if you got someone staying there for a year. So anytime you don't meet that definition of average stay of 7 days or less, or average stay of 30 days or less with the personal services. So anytime you're not meeting those definitions, right, then you're going to be in the box of just a regular old rental property.
So would, I'm just shooting holes at this. Like, what if you're registered as like a corporate housing provider of some sort? Like it's ran as a business, not just a solo person. Does that throw any help into that?
So if all you're doing is basically organizing and, getting people into various units that you own, and they're all staying, a month or more at a time, right? And there's no other services that you're really providing on top of that, then yeah, you're going to basically be just like any other rental property. Okay. Now, if you're treating yourself more like a hotel type situation where you're providing a lot of services, like you're doing daily breakfast, like a bed and breakfast type thing, or you're doing a lot of daily house cleaning, that kind of stuff, then you could be kind of graying it a little bit to where you might be able to get yourself there. But most people that are in that space are not doing that kind of stuff. They're usually just, finding a place, furnishing it, and giving you the keys and stay for a few months or whatever, and give the keys back, kind of a thing. And so, yeah, generally speaking, you're just going to be like any other regular property.
So another question, would you recommend sticking with Furnish Finder, Airbnb, or VRBO? That's kind of more of a host question, but you are a host as well. So do you have any?
I just so happen to do some of this myself. So I like for my extended stay midterm rentals that I have, I do all three. So I got Furnish Finder, Airbnb, and VRBO. I also recently found another site called Corporate Housing by Owner, which also gives you some good corporate housing referrals from people like executives that are relocating and need a place to stay for a couple months while they search for a new house, stuff like that, right? So there's a lot of different avenues out there. And if you get enough of them, obviously creating your own website and having some more direct bookings and doing your own advertising, all that kind of stuff makes more sense, right? And so I found that probably most of my midterm rentals do come from Furnish Finder. On Airbnb, I periodically get somebody who's staying for like a month maybe, but they generally don't book much more than like a month, maybe 6 weeks at most on Airbnb. At least in my experience. I'm sure there's some people that have different experiences. And the VRBO, I haven't had much in terms of the midterm stays on VRBO. Those are usually more short-term stays for some reason. So, yeah.
What about, I like that, was it Corporate
Housing by Owner? Yeah.
Housing by
I think
Owner.
it's like 𝐶HBO.com, I believe. Don't quote me on that, but something like that.
And what I like about this is one thing we always say in the real estate world here at Azreia is if you're going to get an accountant, make sure that accountant has their own real estate. They're an investor themselves, or anything you use in investing. Make sure that service provider does it as well. So I like the fact that we're hitting the short-term rentals, and you also have short-term rentals.
Absolutely. So yeah, I love it. I mean, real estate's awesome. So it's a great way to make some some extra money. And I've honestly found that lately, the midterm rentals or extended stays have been better for me. Just me personally. The short-term rental stuff on Airbnb, VRBO, all that kind of stuff has kind of died down a little bit, for at least for where my properties are. But yeah, I mean, I'm sure there's some people, like if you have a great location where people still vacation to, right? Yeah. Then the short-term rental is going to be more profitable typically. But I feel like here in Phoenix, we have so many back-end offices that keep opening up here that we're going to have more and more people that just need a place for a few months while they're hunting for their own house at some point. So
really agree, man. So yeah. Love it. So is this the last slide?
This is pretty much the last slide. Yeah. So this is just a way to contact us if you need, have any questions, want to just learn some more about us, go check out our YouTube channel. Like I said, that's out there. A lot of great content on there. There's even an episode on short-term rentals. And so, yeah, just a great resource for you to learn some more free stuff. Obviously, we'll be doing some more of these as well throughout the year for you guys. So this is just kind of initial first topic. And if there's something that you want to see in the future, by all means, let Mike or myself know. Something you got questions on that you want us to kind of present on, we're more than happy to come provide some education to you guys. So
yes, sir. Love it, man. Well, that was great, short and sweet, great information, very useful. Yeah, I appreciate you being here, man, and welcome to Azreia, man. Looks forward to seeing you some more.
Absolutely.
All right. If there's not any last questions, I'm gonna wrap it up. Thank you. Yes, definitely was useful. Yeah, once again, man, thanks for being here. That's it. We'll see everybody next Wednesday at 12.
Awesome. Have a good one. Bye.